Hayes here, Chief Marketing and Technical Officer. Just here, we're just going to give a little bit of a weekly recap. Obviously, halfway through the week here, just going to catch up on what's been happening around the markets over the last week, and and then we're just going to sort of see what's ahead and what we can expect the coming days and weeks. Obviously, the market at the moment's been at a little bit of a standstill. We had some pretty hefty moves in December and early February. However, there's been a little bit of a correction so far from mid-February onwards. I think as the looming threat of persistent rate hikes is still persisting, and a lot of market participants are just starting to check themselves a little bit and not wanting to get too carried away just yet, as we have seen some sticky data releases out of the US and Australia. So I'll just share my screen. Okay. Yeah. All right, cool. So the money market for the US, as you can see, there's been a little bit of a pullback in rates. So if we look at the bonds here, T-bills especially, so this is a 6-month bond essentially. It's now risen over 5%, which is a pretty rate. So if you put that in comparison with the federal funds rate, that can be implied that the interest rate in 6 months' time will be around the 5% mark, which is a very large revision to what was initially anticipated that the terminal rate would be, which was expected to peak some stage towards the end of the year. So look, a lot of the market now is pricing in a plus 5% terminal rate for the US. That comes off the back of sticky inflation figures last week. Obviously, month-on-month figure was higher than expected, and there wasn't a decent enough pullback to create any more exuberance on the market. So, and that came off the back of a massive non-farm payrolls number the week before that. So that's really halted the risk sentiment that we did see leading up to those events. Obviously, a big one coming up tonight. We've got the Fed minutes. So they hiked by 50 basis points last meeting. So we'll obviously see there what the board is thinking and what occurred, what the thinking was behind that meeting. And we should hopefully be able to get the gauge on what their next move will be and what their mindsets are leading into the coming months. In Australia, we've seen similar sort of situations. ASX has pulled back quite a bit. It was down another 1/3% today. As you can see here, let's go to Aussie, sorry guys. Australian money markets. So this is all rate pricing. So yeah, as you can see now, our cash rate futures have spiked further. So our 6 months, we're looking at 3.9 to 4% is what's really been priced in with the 3.9 there. So, and that's only 6 months' time. And we look at government bonds, and they're still pretty persistently high. So yeah, that's been the big story out of this week. And we had the wage price indexes. So they were expected to rise 1% quarter on quarter and 3.5% year on year. They came in a little bit weaker, 3.3%, which in a way is a good sign, as it's avoiding the deadly wage price cycle, which central bankers and the economy really wants to avoid. So it was promising, but 3.3% is still quite high, and it doesn't do anything to quell the inflationary pressures that we are seeing at the moment. Bonds off the back of that did rise a little bit towards the back end, but they were fairly muted overall, and those gains were more so a product of the moves we saw in the US yields overnight after they reopened after a public holiday on Monday. So yes, that's the story there. So today we had the New Zealand central bank, the RBNZ, lift their official cash rate another 50 basis points. New Zealand has one of the highest interest rates in the world at the moment, and they showed no sign of slowing down. Obviously, there's been chaotic weather conditions over there and some disastrous events in the form of cyclone flooding and even earthquakes now. So I think it's a really rotten run for the Kiwis, but that's done nothing to slow down their policy tightening. So that they also flagged that their terminal rate's likely to peak at 5.5%. So if we take New Zealand as a bit of an indicator, it shows just how tough and just how far central banks need to actually go to stabilise the inflationary issues and prices around the economy. So yeah, that's the story there. And if they're any indicator of of what could be to come for Australia and the US and other developed nations, then it's an ominous sign. But what we're now really believing is central bankers don't want to be faced with the challenges they were in the 70s, where they cut too quickly and they had another rotten bout of inflation, which was just a massive scourge on the economy and society. And I think they'd much rather a recession or an economic downturn than an event like that. So yeah, with that said, it's probably likely that central bankers will be on the cautious side, and they'd rather overhike than underhike, as much as it is not welcomed by the broader economy. It's got to be short-term pain for long-term gain at this point. Look at the S&P 500. So it's come off the last few days as the market sort of had a bit of a correction and stabilised. Wasn't open for trade on Monday, President's Day, public holiday, but was down flat on the last day of trade, but down around 2%. 2% today. It's actually since 2% on overnight session. Hang Seng's had a torrid run. The last sort of few days it was down the most all year. I think today, if we go here over the last 3 days, we can see that it's roughly, I'll just tilt it in there, roughly 1.5% over the last 3 days, but down from the highs of this is only, well, that's back on the 20th, so Monday, but so down 2.6%, so a substantial decline there. It'd be a similar story with the Nikkei, pretty steep decline yesterday, and sort of followed on from that today at the open. The Aussie dollar, it's mirrored sentiment around the world. It has come off. We saw highs of up in the 70s, just shorten up this time. We saw highs up in the 71s. Since then, it has really dropped off as the US dollar has strengthened and the rates narrative has gained further traction. So now we're currently sitting at 68.34. So yeah, look, where we'll find support, I'd say maybe down at the 67, 66. But yeah, at the moment, it's just all got to do with what Philip Lowe is going to be actioning. Bit of an overview of the currency situation as of today. See, most of the majors were if we do look at the DXY in an individual view, we can see that I'm just trying to so the DXY, so the US dollar essentially has gained some traction over the short term here. So it's really sort of basing out around the low hundreds, hasn't really dipped below the hundreds since Christmas. So could see a basis to be long here, US dollars, with what's to come, and obviously a short stop there underneath the hundreds, which is acting as a compelling piece of support there. So that's really about it. So obviously, the Fed minutes tonight or early morning will be very important, and there's also the PCE indicator for the US, which is a closely watched piece of data. So that comes out on the 24th. So that's Friday, sorry. So that's the closely monitored indication of inflation. So we'll see what comes out as, but that'll be quite telling, very telling indeed. Change my sharing here. A bit of an overview of what's happened today, just a live look. The indices here across Asia and the world, all down, all in the red. The ugly day for equities overall. US yields are gaining some traction, down a bit. So bonds have regained ground. And interestingly enough, bonds did lose ground on the day. So this is the yield, remember, so that the bond itself has climbed. It crosses there, Australian strength overall. For currencies, the Aussie dollars was one of the biggest losers, funnily enough, even though our yields were higher. Euro was marginally higher, the pound was up, the CNH, the Chinese yuan, was down, but the rest of the currencies have enjoyed a higher day. So yes, that's sort of the week ahead, or the week that's been, but obviously pretty important data out of the US tonight and Friday. We will wait for that, and I think we'll start to see the next more prominent moves. But at the moment, all things are leading to stronger US dollar and weaker risk sentiment. So equities, I think, will be will be affected. I think bond yields will probably climb another leg higher. So yeah, that's my take of it. But we'll come back, we'll reassess in a week or so's time, and we'll see where everything's at. Okay, thanks a lot, guys. Yeah, we'll touch base later on. Thank you.